Hi, I'm Bruce with Clayton Biltmore Financial. Thanks so much for joining us on this brief webinar. It's going to be about 20 minutes, and we're going to cover several different strategies on how to provide a guaranteed retirement income, diversified portfolio strategies, and some other things to provide you with a stress-free financial retirement. So what I'm going to do is I'm going to share my screen and do a PowerPoint for you. I promise it won't be boring, and you'll get a lot of good information. Here we go. The goal today is to figure out how to create a stress-free financial retirement. As you get to retirement, the paycheck goes away. So the question is, you save money, you're going to have Social Security, maybe a few other sources of income. So how do you create a stress-free financial retirement with some predictability and consistency so you don't have to worry about your finances in retirement? Okay. First of all, let me tell you about Clayton Biltmore Financial. We provide retirement solutions to pre-retirees and retirees to help provide a stress-free financial retirement. Okay. Our firm's a collection of professionals that put the client first and foremost. The reason I say that is all our plans are customized for your individual goals and objectives. Okay. We're not going to sit there and give you a cookie cutter, portfolio model with X% in bonds, X% in stocks, because that's what the company directs us to do. We don't do that. We look out for your individual goals and objectives and come up with a plan and recommendation that makes sense for you. We're headquartered in St. Louis, Missouri, but we do business in a variety of states and have clients all over the country. First of all, let's talk about why you're here today. There's probably several different reasons. One, you're looking for predictability. You're looking for a consistent source of income in retirement, and you don't want to run out of money in retirement. And we call that creating a modern day pension. Okay. You're looking for safety. You don't want to worry about the ups and downs of the stock market or other investment vehicles, and you don't want to lose your principal. You spent years accumulating this nest egg. You don't want to lose it to variations in the stock market or other investments you have. You want to minimize taxes. Especially as you get older, the less you can spend in taxes, the better off you are. Most you'll be in a lower tax rate, but still, like I said, the less taxes you pay, better off. Inflation. A few years ago, it wasn't a concern. Now you don't know what inflation is going to be. It's changed drastically in the last couple of years. Maybe there's some other considerations like required minimum distributions or long-term care. Do you have a need for long-term care? There are a lot of options we have that might be unknown to you. If any of these are concern to you, then you're in the right place. First of all, let's talk about the U.S. and the world economy. The place is changing drastically. I mean, it's volatile nowadays. Markets can go up or down 20% in a day. The BRICS, Brazil, Russia, India, China, South Africa are talking about coming up with their own reserve currency. There's a lot of volatility in the market. There's unpredictability. Things like, is there going to be another COVID where everything shuts down? I mean, who could have predicted that? So you got to be concerned because losses that occur now can deeply affect when or even if you can retire. How many people out there have or know people or even had to go back to work yourself because something happened with your portfolio or your investments didn't perform like you thought? Look at the S&P. It lost 50% of its value in just a month. In a year. So think about how, could you take that kind of a haircut on your portfolio? Can you afford a big downturn? So what are the pillars of a successful retirement strategy? Okay. One are protection of principal. First of all, you got to protect the principal. As Warren Buffett said, rule number one of making money is don't lose money. You want to position yourself for growth, no or low cost. We specialize in no cost programs. Fees eat up returns, 1% here, 1% there, and all of a sudden your portfolio has got quite a drag on it. If you want to have flexibility and access to your money, you want diversification, and you want to have a strategy that fills the income gap in retirement because you no longer have a paycheck. So where are you going to get your money from? Well, 401k or a pension, And if it's a pension and you work for a private company, it's not going to be much, because I've worked for a company and they use the 401k versus the pension. Brokerage accounts, bank accounts, social security, maybe you have some rental property, precious metals, insurance policies like an index universal life. The question is, how do you use these to fill the income gap? And we have great strategies to do that. First of all, before we get into that, should you invest in a 401k? That's a question we always get asked. And the answer is usually yes, especially if there's a company match. But there's other options for excess funds. And if you want to be protected from downside losses, there's also always rollovers you could do, so your money's protected and continues to grow. So are your funds protected from downside risk? If you get stressed out every time that statement comes, you're wondering if you've lost, 5, 10, 15, 20%, there's ways to avoid that. Let's talk about Social Security. As you can see from this pie chart, Social Security is going to provide about a third of an individual's retirement plan. So how are you going to fill the other 2/3? Okay. For most people, it's the number 1 or 2 source of retirement income. But once again, there's 66% that's unaccounted for. And we focus on that side of it. We also tell you how to maximize your Social Security. Should you take it at 62? Should you wait for full retirement? Should you wait till 70? There's a lot of analysis that goes into which is the best option for you. We can help you with that. How much can you receive in income? I mean, this is just an example, and these are hypothetical. Individual benefits vary, but let's say you were making 50,000, you could be as low as 1,400 if you're taking it at 62, or it can be over 4,000 if you wait, depending upon your annual income. But as you see, if you're making 1,400 and your expenses are 3,000, you've got to come up with that other 66% that we talked about. And how are we going to do that? So some strategies to fill in the income gap. One is an annuity. There's fixed index and multi-years. And I'm going to get into these, but annuities are fantastic. They've got great annuities out there. We work with some of the top companies in the country, and they're just fantastic products. There's CD laddering you can do. There's dividend portfolios you can structure. There's index universal life. So in addition to protecting your principals, these offer growth, tax minimization, and a few other benefits that we'll get into. So like I said, keep asking yourself, how are you going to fill the income gap in retirement? So let's talk about an investment vehicle that offers guaranteed income for life, guaranteed minimum rates of return, depending upon what product you choose, safety of principal, tax-deferred growth, flexible yearly withdrawal options. We call it the modern day pension. Create your own modern day pension. You don't have to rely on a company. Annuities. There's fixed index annuities, multi-year guaranteed, immediate, and variable. With a fixed index, they pay a return based on the performance of a market index. So when the market goes up, you gain. When it goes down, no losses. And I'll get into that. A multi-year guarantee is very similar to a CD. Okay, it offers guaranteed interest rates. There's immediate annuities called a SPIA, where you put money in and then you get money payments right away for life. And then there's variable annuities. We don't get into these for a variety of reasons. One is they're very high cost and they carry substantial risk. And like I said, it doesn't fit in with our strategy of a stress-free financial retirement. So let's talk about a fixed indexed annuity. Okay, a fixed index annuity is a type of annuity that generates return based on performance of a market index. So it's tied to an index. So if the S&P goes up, you gain from that. If it goes up 20%, let's say you get 15% of that. It's essentially the best of all worlds. By providing complete downside protection, you never lose any money, meaning your no principal loss, and your gains are locked in each year. So let's say you start off with 100,000. The next year you get a gain and it goes up to 110, and then the market tanks and goes down at 20%. The following year you're starting off at 110. The benefit of that is called sequence of returns. You don't have to spend your time gaining back what you lost. Okay. Many of these annuities also offer long-term care options as an added benefit, which most people don't know. They offer doublers, where if you're getting income, they'll double it. If you've got the two of the six activities of daily life impingements. So there's great added value benefits of a fixed index annuity that you wouldn't get in some other strategies. Okay. So how does it work? Basically, like I told you, the return is based on the index, like in S&P 500. When the market goes up, you participated. There's losses. It stops right there. No losses. It's credited usually once per year. How is this going to work? Well, the insurance company who this is a contract with, insurance companies are the most dependable financial entities in the country and probably the world. I mean, even banks put their money with insurance company. So the insurance company captures the returns after a certain point to compensate them for the risk. So for example, let's say the market goes up for 20%, you might get 12 or 15%, but that's fair. They get paid for performance and they get compensated for the risk during the bad times. Let's talk about a multi-year guarantee of annuity. It's like a CD on steroids. It offers a guaranteed fixed rate for a certain period of time, anywhere from 3 to 10 years, and they're good for someone who prefers a guaranteed investment return. Also, the difference is on a multi-year guaranteed annuity versus a CD, you can pull some of the money out year to year. With a CD, you can't. If you pull any money out, you've forgone all your interest. Okay, let's talk about some famous people who invested in annuities. Babe Ruth did. Back in the day, Babe blew his money like crazy, so he ended up putting some of his money into an annuity way back when, and I won't go through all the specifics, but it looked like when he retired, he was able to generate about $290,000 in today's dollars. So one of his quotes was, "I may take risks in life, but I never will risk my money. I use annuities." He never has to worry about his money, even back then. And now the annuities are even better and more sophisticated. Okay, let's talk about CD laddering. What is a CD? It's a savings account offered by a bank and credit union, basically. It pays higher than average rates. But let's talk about some of the pros and cons. First of all, yeah, your principal is protected up to about $250,000 per account, various lengths, and higher rates than normal savings account. Okay, some of the cons are early withdrawal penalties. You're taxed on income earned in the year received, and they usually pay less returns than a multi-year guaranteed annuity. So CD laddering is an option, maybe as part of a diversified portfolio, especially if you're extremely risk averse. Let's talk about dividend portfolio. So what's a dividend portfolio? Using dividend paying stocks to provide retirement income. Okay, there's a lot of stocks out there that pay dividends anywhere from 4 to 6 to 8% or higher, and it's across a variety of different industries. Okay, so some of the pros of that is it diversifies across different companies, so you've got diversification. A lot of times dividends tend to grow over time, and these companies are usually companies that have been paying dividends for, I think, maybe some up to over 100 years. Dividends are taxed at a lower rate, and there's opportunity for principal appreciation. So your stock dividends or your stocks can grow. But here's some of the cons. The company can cancel the dividend at any time or reduce it. So if you're relying on that, there's some concerns there. Dividends are taxable in the year received versus an annuity, which they can accumulate, and your principal is not protected. So your stock portfolio can decrease. There's no guarantee that if it's a $50 stock, even if they're paying a good dividend, it could go down to $25, who knows? So there's variability there. Now, the other thing you can do is look at annuities and some of these others, a bond replacement. So a bond replacement occurs when you move money, your investment bonds, to a safe investment vehicle. As I mentioned before, a lot of companies have a stock and bond portfolio mix. I don't like bonds. I'll be very honest with you. Okay, here's why. There's interest rate risk. They can, you never know what the new bond is going to generate in terms of interest rate, reinvestment. Can you buy the bond again when your bond matures? The system, I mean, what happens if debt becomes overwhelming? And my main concern is bankruptcy risk. Why do you want to buy someone else's debt and promise to pay? The only bond I would buy would be a treasury bond, because the government can print the dollars. States can't, municipalities can't, corporations can't, so there's that bankruptcy risk. So I'm not a big fan of bonds, but we do work with them, but I'm not a big fan personally. Minimizing taxes. Everybody wants to minimize taxes and they're looking for a golden or, a silver bullet, but really there aren't any. There's a couple of ways to do it. There's probably several more. We also have, just so you know, we have a CPA that we consult with. So anything we do minimizing taxes always fits within the IRS code. Okay. There's Roth IRA conversions where you pay taxes now versus later. That's where you roll over amount, let's say in an IRA or 401k into a Roth rollover. So you're converting it to a Roth. You pay your taxes now, but you never have to worry about paying taxes on any of that, any of the converted funds, the growth in the future. So you don't have to worry about paying taxes again. You just have to make sure that when you do that, you don't bump yourself up into too high of a tax bracket. So it's got to be done very strategically. But that's a great way to move your money and never pay taxes again. It's called a backdoor rollover, because if you go to buy a Roth IRA, there's limits on what you can move. Depending upon your age, is about $7,000 a year. With this, there's no limit, so you can move it over. There's just some concerns on maximum income that you earn and things like that. So we just have to be very strategic on how we do it. Another is an index universal life policy. Okay, that's a combination of insurance and investments where you can overfund the premium. And then you can take out, as it grows, you can take out cash value with no tax implications down the line. This is good for, it's a sophisticated investment. It's good for people who are a little bit younger because it takes time for it to really percolate and grow. So you want to have about 10 years before you start taking the money out. But that's another strategy I just wanted to address. Okay. So I covered a lot of strategies. I went through it relatively quickly, so I hope I didn't talk too fast, but the goal is building your stress-free retirement. How do you do that? First of all, we have a conversation to understand your retirement goals, okay? We do an analysis of the income gap. Where's the money coming from, how much you spend, etc. We provide recommendations to fill the gap using various strategies. Some of the ones we just mentioned, maybe there's some others we can discuss. Let me put the plan into place. It's a simple process, but a thorough one. For example, this is just kind of one of the reports, one of the pages from a report, just shows like where you stand, what your chances are, where the money will come from in the different buckets at the bottom. So we go through these in detail to give you a very high confidence level that you'll be able to enjoy your retirement and have a stress-free retirement. Stress-free financial retirement. So the next step is, let us show you how to guarantee your retirement income. First of all, protect your principal. Let's provide a diversified, flexible plan. Let's look at minimizing your taxes. Let's look at protecting you against inflation. Let's look at potentially long-term care, because at the end of the day, we want to fill that income gap so you can, once again, have a stress-free financial retirement. Anyway, thank you so much. I really appreciate it. There's going to be a link here if you want to do some top line analysis yourself of where you stand. And we may contact you with an email, but I'm just like you. I don't want to be barraged with some guy calling me to set up an appointment or all that kind of stuff. If we can help you, we'd love to. We work with a variety of clients, like I said, all across the country. So if you want to have a conversation, we're here to help, but we're not going to barrage you with phone calls or having our assistants or myself call you to set up appointments. We really appreciate your time. Love to work with you. Thanks so much. Have a wonderful day.